Trading 212 is a relatively new financial technology company that targeted brand new investors like me and probably like you, and holds lots of new investors' money in the UK and the EU. The big news right now around inflation and interest rates and banking collapses is that new technology companies might not have any money available to borrow.
It's not supposed to be easy for companies with bad business models to stay in business, as it has been for the last 14 years.
This could lead to slow growth, and for some of these companies, it might stop. It's potentially as at risk as every new technology company, every banking company, and every stockbroker.
At one point, PayPal was the darling of e-commerce. These days, it looks more like a bank. And right now, bank stocks are poison.
So today, I'll discuss how, if at all, Trading 212 could be affected by the recent Silicon Valley Bank run, the recent buyout of Credit Suisse, and the recent fall of First Republic. By the way, this event is so sensitive right now. Things are always changing. The information I'm sharing is correct to the best of my ability, and that ability to deliver information is questionable. The infamous collapse of the Silicon Valley Bank has rocked the tech sector over the past few months. This is a somewhat unprecedented situation where the 16th largest bank in the US announced that it was completely insolvent. This led to some of the biggest businesses in the world attempting to withdraw all their money at once after realizing their money held within the bank was not insured by the FDIC. This is better known to you and me as a bank run, where customers attempt to withdraw all of their deposits all at once, causing a shortfall in liquid cash, and the bank can't squeeze any more money out.
I've got nothing left. I've got nothing left.
This isn't supposed to happen in the modern age. The last banking run that I can think of in the UK is the nationalisation of Northern Rock, when the global financial crisis had depositors queuing around the corner to get their money out. Literally, in person, queuing around the corner. Believe it or not, queuing used to be a great way of dealing with a bank run. In 1907, famously, JP Morgan, that's the man JP Morgan, not the bank, ordered his tellers to count the cash slower. This was to slow down the process and ease the effect of that poor liquidity, that inability to get the money out the door. These days though, and particularly for Silicon Valley Bank, everything is ordered at the click of a button and in far greater amounts than in the 1900s. It's possible over the next few years, credible banks that have taken part in risky lending could struggle to stay liquid during this rise in interest rates as unprofitable businesses fail to meet their debt requirements. You have to remember though that Silicon Valley Bank and First Republic haven't actually been doing anything illegal. There wasn't anything dodgy going on, they just took too much risk, and it's probably going to change the rules of banking. Again, at the moment, it's near impossible to raise capital on a risky business, and a fintech company like Trading 212 could be at risk of being lumped in with the other companies that may suffer from this style of bank run. And there's two areas that I've identified as risks for Trading 212. The bank that Trading 212 holds both theirs and our cash assets suffer a bank run. So if they're invested with, say, Silicon Valley Bank, they will struggle to get their money out as they probably come quite low on the totem pole behind Roku and Coinbase. And the second risk is that Trading 212 suffers a deposit run itself, and it's unable to liquidate its assets quickly enough. It's possible that the bank that Trading 212 hold our assets with could go bust. For instance, do many people know that Apple's 4.2% in their savings account on Apple Pay is actually run by Goldman Sachs? It could quite easily have been Credit Suisse. Trading 212 is required by the FCA to make sure that any cash that is held by customers is segregated into a bank account away from Trading 212's own assets. So if they did go bust for whatever reason, they couldn't take your money to help save their business. It's just not allowed. It also holds our physical shares with a third party. Currently, as far as I'm aware, this is Interactive Brokers, one of the largest and I assume one of the most liquid stockbrokers in the world. The bank that Trading 212 currently banks with is Barclays. This means that any cash that's deposited and held by me in my Trading 212 account sits separately so that Trading 212 can't get at it if it's become insolvent. And a lot of the more savvy viewers will be screaming at the screen right now saying that it's also insured up to £85,000 by the FSCS, something that I've covered before and I'm sure I'll cover again in the future. Queues outside of banks like 2008 are unlikely. Banks are now required to pass multiple stress tests, and they have to show liquidity for an event that's as big as 2008 times 3. So, Trading 212's funds are held with a pretty solid, well-known and reputable bank. And that, I realise, doesn't hold as much weight these days because of the whole Credit Suisse thing. However, because this money is held with Barclays, which I do think is much stronger than Credit Suisse, I'm considering this risk as improbable, but not impossible. If large banks such as Barclays are getting run on, something big is happening. Something probably far worse than the stock market crashing. I'd also question whether central banks and governments would allow a bank like Barclays to go bust. Barclays is a GSIB, globally systemically important bank. A failure of a bank this size would collapse the entire purpose of a savings account as a safe investment. We would have to expect the average person to become an earnings report reader just to deposit their monthly wages. They would have to know the ins and outs of every single bank. I don't think that's going to happen. So, as far as Trading 212 suffering from a depositor run from its bank, it's not banking with Crypto RS. It's as safe as it can be, as far as I'm aware. But that's not the only depositor run that Trading 212 could suffer from. Trading 212 takes deposits and allows withdrawals all within a few clearing days. I've withdrawn a lot of money from Trading 212 in the past myself. So what could happen theoretically is that during an economic event such as a recession, investors could want to sell up all of their stock and start withdrawing quickly. This, in my opinion, is a much more realistic scenario, though I still see some positives despite the real risk that exists. It moves so quickly I can't keep up with how much Trading 212 holds in assets. Last time I checked it was over 3 billion, but I suspect that it's far more than that right now. That's a lot of cash for a small business to get out in a hurry. However, its customer base are investors, and Trading 212 isn't a bank. You'd like to hope that if there's significant volatility in the stock market, inflows into Trading 212 would remain stable as investors look to capitalize on the lower prices. You'd like to hope that would happen anyway, but history does suggest the opposite. Another cause of a run on Trading 212 would be that they begin to run into real financial difficulty. Every year I try to check on Trading 212 and their financial situation, and so far I've been pretty satisfied that their business model is going completely as planned. They're a very small business, they don't have many employees, and they keep their CapEx low, even though their margin is pretty small as well. This is unlike other platforms who are raising their prices on their customers, and the future doesn't look as hopeful for them. I've made plenty of videos on the financial status of Trading 212, so I won't go into too much detail, but the short version is that Trading 212 has increasing revenue from a strong CFD platform. They generate share lending revenue from short sellers externally, and as far as I can tell, they have low debt and no venture capital outside of their founders, which means in a crisis, they could go externally and try to get some venture capital. There are, of course, many risks, one of them being that the CFD platform collapses and the masses discover that CFD is basically gambling. But the world's known about that for years, so I don't see why that's going to change anytime soon. The focus in the US was on the FDIC insurance. In the UK, we have a similar insurance scheme known as the FSCS. This covers any cash amount up to £85,000 held per person in Trading 212. High street banks and pretty much any other form of legal way to save and invest your money do this as well. And the system worked better than expected for the billionaires holding money at Silicon Valley Bank. But there's no reason to think that the FSCS scheme won't work well in the UK. In fact, I have a video on what might happen if Trading 212 went bankrupt, which details a couple of cases where the FSCS has stepped in and intervened with very good results. Trading 212 could also be mismanaging their accounts. There's always a risk that companies are doing something fraudulent, but that would be difficult to find out. If something dodgy was found to be going on, or something changed in Trading 212's business model, like if all of a sudden they decided to change their whole free model and started to charge huge fees, I'd be worried there would be significant withdrawal there. It would cause the same situation that all funds, banks and brokers fear, that the party is on fire and the fire escape is too small for everyone to get out alive. So personally, I'm quite happy that Trading 212 is fairly safe from a depositor run, though it is a very real possibility that something like that could happen. Please verify the things that I've said in this video yourself. This video was simply designed to spark thought and consider risk when investing in Trading 212 or any other broker for that matter. And if you want to see my last video on Trading 212's accounts, see this video. And if you want to see what happens when Trading 212 goes bankrupt, take a look at this video as well. Cheers very much.